has stopped going up. So we'll go ahead and get started. And again, thank you for your patience and thank you for joining me this morning as we talk about ECO. I want to talk a lot about the why this morning, not just the what. I know that most of you know what ECO is. We had a webinar back in the fall and talked a lot about the details of what ECO is this year. And so I'm excited about this program, have been since it came out. The fact that it's a subsidized coverage up to 95%. Gives us some tremendous opportunities this year. And from the producer standpoint, we haven't had a chance to really lock in profits with crop insurance for 6-7 years. And so producers are going to have that opportunity this year with some of these higher level coverages based on where the prices are starting to be set at, assuming these prices hold. So this is why I think this is a great opportunity and want to focus on that here this morning. So thank you for joining. Some of this detail, what's the situation for 21? Got a lot of things going on this year. Number one, stocks are tight for corn and soybeans. They're getting tighter for wheat and cotton. But when you look at the U.S. stock situation for corn and soybeans, this is kind of what's put prices where they're at right now. But if you go back 6 months, we were looking at a corn ending stock number of over 3 billion bushels. That would have been the largest in 32 years. So we've gone from a situation of extreme high stocks in corn to all of a sudden the tightest that USDA has forecasted on this date in the last 6-7 years. And so that's really changed things a lot. Soybeans as well. We've gone from a very plentiful situation of over 600 million bushels down to 140 million in this last USDA report. So things have tightened a lot. That's given us the boost that we've seen in prices. World demand has grown at the same time. That's part of the reason we're seeing U.S. stocks drop, but Chinese buying really picked up in August, starting in August. I don't have this updated chart through December, but their imports from the U.S. have been phenomenal over the last 5 months, and that's been the driver for a lot of this rally that we've seen. Speculative funds are holding the largest long position for this time of the year they've ever held. And the black line shows where these speculative funds are at with their net position. And as of the end of the year, again, holding over 800,000 contracts long combined in grains and oil seeds. And what a change it's been. If you go back to just back in the middle of August last year, they were short 200,000 contracts combined. So they've bought, what's that, over a million contracts of grains and oil seeds and really given us the boost that we've seen in this market over the last 4 or 5 months. And you can see, 800,000 contracts combined is just about where they were back in the drought of 2012 and previously in 2010. So, this provides some concern to me that if and when these people decide to sell off this position, it could get pretty messy in the market. But in the meantime, they've certainly given us a great opportunity. Brazil is going to start harvesting beans soon, corn as well. This crop coming off down there is going to be big, but it's going to be a little bit late because they were late getting planted. And you can see that starting harvest is just a little bit behind normal. I think that's going to continue to drag over the next couple of weeks because of the lateness of the crop getting planted. But nonetheless, they're going to have a big crop. I know it had gotten off to a rocky start. They were awful dry early, have gotten some rains lately, and now the forecasts continue to come in over 130 million tons, which is a big, big crop that we're going to be competing with here starting here in a couple of months. We're going to see acres increase this year. As always happens when we see big high prices, we see acres increase. Brazil increased bean acres nearly 4%. U.S. acres are destined to jump this year as well. And the big reason is we had a lot of acres set aside over the last 2 years due to prevented plant. If you go back to 2019, we had nearly 20 million acres in the U.S. that didn't get planted. And last year still had about 10 million acres. Both of those numbers well above normal. And you would assume with prices where they're at, that producers this spring are going to do anything and everything they can to try to get a crop in the ground. And so I would anticipate a very low prevented plant number this year. Consequently, a lot of these acres probably will go to soybeans, some to corn here in the year ahead. So that kind of leads me into the conversation of enhanced coverage option. How does ECO play into this period of high prices and maybe some uncertainty into 21, but with tremendous opportunity that we've got due to those high prices. And I am very proud to say that Jim Corin, our president of NAU Country, along with Watson Associates, those two parties were really responsible for getting ECO pushed through the RMA. We have really wanted to get some sort of a subsidized crop insurance, a spring policy that producers could use to get more coverage. And, you know, when we started this process, we had prices much lower, but the idea is still the same, and that's to try to get producers a way to be able to get enough insurance to cover their cost of production and or to be able to insure a profit. And we didn't have the idea that prices were going to be here when we did this, but nonetheless, this has given producers, I think, a tremendous opportunity here for the 2021 year. So just a few of the basics before we get into more of the whys and how we can use some of our tools to be able to try to show producers how this thing's going to work. But if you are familiar with the SCO, the supplemental coverage, then you're going to understand ECO. SCO came out, I believe, 3 years ago, and it is a county-based coverage that allows producers to cover from their individual coverage level up to 86%. So for example, if you were buying 75 or 80% RP coverage, you could then cover the next 11 or 9 or 6% from that level up to 86% based on the county. And it's a subsidized coverage. So that we were pretty excited about that, especially in some areas where producers weren't currently buying 85% revenue coverage. ECO then extends that. ECO allows us to extend that from 86 to 90 or 86 to 95%. So it's a great tool to be able to get additional coverage. It is an endorsement to your individual coverage. It's going to match the individual coverage. So producers that are buying yield coverage on their farm are going to have ECO that's based on yield. If you're buying revenue coverage on the farm, your ECO is going to be revenue based. And it's going to be available for 31 crops this year and more next year. And you can see here's the entire list that's available for 2021. And again, we're going to see some crops added then for the 22 marketing year. And this picture really shows the benefit, I guess, of the ECO. You're shrinking your deductible. We're limiting the amount of that red at the top of these charts. And both of these show one with 90, one with 95%. But if a producer starts with 75% multi-peril insurance, he can add SCO coverage from that level up to 86%. You could then add ECO protection up to 90 or 95%. So we're shrinking the deductible. This says SCO or ARC coverage. And so I think it's a good time to talk about that just a minute. SCO, keep in mind, is based on your planted acres, and so is ECO. But these are both based on planted acres, and they're going to use the prices that are being determined either right now in the South or in February in the remaining states. These very, very high prices we have right now. The ARC coverage, ARC is using, I believe, 370 for corn. It's using 895 for soybeans times 86%. So you're not getting near the coverage with ARC that you can get with SCO. So I know that we're talking about ECO here as well, but I know there's been a lot of discussion about should we sign up for the ARC program or PLC. I'm here to tell you that SCO is going to get you a lot higher coverage than ARC is because of the prices that we're going to be using this year. So how does it look in the chart? And these are the charts I've been showing you here for a few months. This is the December 21 corn chart. And wow, has it changed in the last 2 months? If you go back to November, early November, we were trading corn in the 390 area. Fast forward to last night, we closed at 455 on December futures. And these orange lines on here, I've drawn these in to really show how crop insurance is going to work. And this makes the assumption, let's assume that we start out with a 455 base price. I don't know where we're going to end up here in February. But if I also make the assumption that my county is going to have an average yield, then a 5%, it only takes a 5% drop in the price to start to trigger an ECO payment at the 95% level. And that would, what's 5% of 455 is about what, 23, 24 cents. So you would only have to see price drop into the 430s to start to trigger an indemnity. At the 90% level, a 10% drop is about 45 cents. So that takes you down to about 410 a bushel. So at both of these levels, we're able to get what I would call price triggers way above where D's corn had even traded up until 2 months ago. And so this is why I'm really high on this product. SCO at 86% coverage would require, if you have an average yield, a 14% drop in price takes you down into the low 390s. And if you're buying 80% revenue insurance, then if you have an average crop on your farm, you have to have a 20% drop in the price. That's down in the 360s. So this, to me, really shows the value of these higher levels of coverage and the fact that you're getting some market protection up at this 95 or 90% level, or even at the 86% level with SCO. Soybeans, similar looking chart. If we start with 1189 price, that's where we were last night. A 5% drop is down to about 1130. And shoot, we hadn't traded to 1130 until the beginning of January. So it's, to me, it kind of works like a put option. You're getting a very, very high trigger built into your revenue. 10% drop, you know, if you drop down to 90%, that's still in the 1060 to 1070 range. And the SCO at 86% is down around 1030. All of those, I could make a strong case that if we have a big crop this year, you could make a strong case that we could be below some of those levels. And so, so just kind of keep that in mind. Crystal asked a question, and I'll hit on this in a minute. Do you have to carry SCO with ECO? No, you do not. You can leave a gap in your coverage. And so some producers may choose to spend their crop insurance money by buying that higher end ECO along with a lower level RP policy just to be able to get that high triggered. We'll talk about that here in a minute. Cotton, we have it available for cotton this year. And, you know, if you look at where the cotton market is running right now, we're pushing 78 cents. And, you know, if you look at SCO, a 14% drop in price is about 66 or so cents. And we hadn't been above 66 cents till the late August. If you go up to the 90% trigger, you know, now you're up into the 70-cent range. So may want to consider it on cotton. Minneapolis wheat, same thing. With this recent spike we've had, we've rallied $1 since the beginning of December. A 5% drop we hadn't been above until just a few days ago. And in fact, so the higher we get these base prices set, these other products may allow you to lock in some revenues / price levels that we haven't seen in quite a while. So moving on to some of the other decisions, producers must purchase an individual policy in order to add ECO coverage. And the question that was just asked, you may purchase SCO along with ECO. You could leave a gap in your coverage if you wish. And again, I could see some producers maybe deciding to do that this year, to where they buy 75 or 80% RP coverage just in case there's a disaster on my farm, if I have a big drop in yield, but maybe take some of the savings by lowering my coverage on RP and going up and buying ECO from 86 to 90 or 86 to 95. Get you a lot higher trigger than what you were currently seeing with your other individual coverages. So something to consider, and we'll talk about. Dylan asks a question for corn. Would you still recommend PLC and SCO if someone takes 85%? Rather than the 75% level in your example? Or would ARC be better? I don't like ARC on corn unless you live in a state way away from the center part of the corn belt, because, you know, with ARC at 370 starting price times 86%, that's 318. You know, the odds of having a loss, you know, if we have a loss in the corn belt and the corn market goes up, then ARC probably would never pay. I think that there's an outside chance that we could get below the PLC trigger price at 370. And if that's the case, then maybe you could do something with SCO on top of PLC. I wouldn't buy it if I had 85% multi-peril. If I was doing the 85%, I would leave the SCO out and just do the ECO if I wanted some additional coverage. Feel free to email me later, Dylan, and we can talk a little bit more about that. Going on, ECO is not impacted by PLC and ARC decisions. So because it starts at 86% coverage, it doesn't matter which program you select. SCO is impacted. You have to enroll in PLC in order to buy SCO. ECO is going to be subsidized at 44%. That's a phenomenal subsidized rate. And so, you know, with the government picking up a big chunk of this, it's a lot cheaper than buying a put option. And I know a lot of folks have talked about going to the market buying puts this year. And I've written a little bit about that too. But ECO being subsidized, it's going to be a lot cheaper to get some coverage that way than possibly going through the market. Some of the details on the indemnities, ECO's expected and final yields are based on RMA data. Same as all the other county insurance products. The SCO, the margin protection, the RPI policies are all using RMA data now. The final yields will not be released until late spring because now we're waiting on RMA data to come in. So indemnities don't get paid until the early part of the summer. To me, that's the negative about this, is that you don't get the indemnity until later on. You will get an indemnity if your underlying RP policy does trigger, and that would get paid in the late fall. ECO indemnities are going to be impacted slightly by the producer's APH, and I'll show an example of that later. But if your APH runs higher than what the county's expected yield is, you're going to get paid slightly more than the county average on an indemnity payment. And these are not connected. So you could have a loss on your farm, get an RP payment, not get an ECO payment, or vice versa. So it does help if you're if you do tend to track with what the county does. Nick asks the question, if you select ECO and irrigated acres, do you have to purchase on dry land as well? Good question. I'm going to say I think so, but I think that's a question you should ask your underwriter to make sure. So that is, I'll defer to the underwriter on that one. So to me, each agent on this webinar probably has at least one producer, probably many, that would be good candidates for ECO. And the reasons are you've got a 95% coverage. It's the highest subsidized coverage available, and we can help cover cost of production. It is a county-based product. For some, that's not a good deal. For others, it's a very good deal if your yields tend to track with or better than the county average. It only takes a 5% drop in revenue to trigger a payment. So that could either be bushels, it could be price, it could be some combination. But the final point, most counties likely have an opportunity to protect the highest amount of revenue ever. You know, if you go back to 2012, in the drought year, we didn't have any of these additional policies. The highest we had was 85% coverage. And in 13 and in 14, the years following, when we had very high prices, after that, prices went way down. So now the prices are up at these levels and we have 95% coverage. It's probably the best opportunity to lock in the highest revenue ever with a crop insurance policy. So I want to take you through on a little bit of a tour of some of the tools that we've got available. I'm excited about a lot of the stuff that our IT group has been able to build for us to be able to show you. And so first off, we're going to start, we've got two different places, but the first set is in our quoter, in the Easy Quote quoter. And so if I go into Easy Quote, click on the MPCI, like I'm going to run a quote, here's what I see. Here's my quote screen. So I can type in my state. And for this example, I use Christian County, Illinois. I type in the crop, corn, or click on the corn, click on revenue protection. In this example, I clicked on an 80% revenue policy. It doesn't really matter if I'm just looking at ECO quotes here. And then I click on the endorsement below, and I can click on SCO and ECO. In this example, I just did the ECO only. I'm going to start out looking at 95%. I'll come back later in a minute and look at SCO and look at a lower level ECO. But for now, I want to look at 95%. Put in the acres, put in my trend adjustment if I'm using that. Put in the price and volatility. And the one thing I will mention is that the volatility factors in the southern states are starting much higher than what we had seen a year ago. And in fact, after 2 days, we're using 21% volatility on corn in Louisiana and some of the other southern states. So keep that in mind. If you're in a northern state, we haven't got to February yet, I would run my quotes using 21% right now. And that's a far cry above the 15 I think that we had a year ago. And it makes a big difference in the premiums. And I'll point that out here in just a minute. You can put in the price where we're running at right now, approved yield. In this case, I used the 10-year average. This was for a prospect, but I went in and typed in his last 10 years worth of yields to be able to show this. Then our next page, when we hit save and move on, the next page is going to show my line items. It's going to show what the quote would be. The top line on here is for my RP insurance. It's going to show that my quote at the 80% level was $12.76. It shows my approved yield of 215, my rate yield of 204, my trigger yield of 172, and that's with an 80% policy. And by the way, this, and Hope wanted me to mention this, that these columns on here, you can change these. If you right click on this row up here, it's going to give you a bunch of different selections or elections that you could choose to want to show. And so I changed a few of these. I added the trigger yield. I wanted to see what my trigger yield was going to look like. So I added that. That's not in one of the defaults, but if so, some of these, like the expected yield in the county, might not have been in there. So you might want to add some of these and move some of these around to be able to look at them. But it's kind of cool to be able to see it right on this main screen. It also shows me what the net premium is, $29.27. Let me explain a little bit. About 2 weeks ago, when I was running this quote, using about a 415 price and using 15% volatility, this quote would have been about $21. So the rise in the price to 455 plus the increase in the volatility factor, I guess I use 450 price, but those two price numbers increasing have changed this net premium. So this could continue to change and will continue to change until we get final prices and volatilities set here in February. Next, I can look at the scenario button up on the top left of the quoter. The last one was full farm. If I click on the scenario, it's going to show me some different information here. It's going to show me, first of all, you can see down at the bottom of these the bar charts, 75, 80, and 85%. I chose not only to show the level of coverage that I was going to buy at 80%, but I wanted to look, what if I went up 5 or down 5%? And I can change these over on the right-hand side in 75, 80, 85. I can look at as many of these as I want, not just the one I picked. The blue on here, I've set this to be able to show 95%, and I set the brown to show 90%. So I can also not only just look at what I intended to buy, but I can look at the alternatives as well. So at the 80% coverage level, if I'm buying RP plus the ECO, these are the numbers I looked at on the last screen on the full farm page. But it's also showing me an alternative. If I decided maybe I just want to do 90% ECO, that's going to run about $10.79 an acre. And it doesn't matter what your coverages are. The ECO and the ECO at the 95 and the 90 are going to be the same. It's just that my RP coverage goes up or down depending on which level I'm at. Also want to show you off to the right, by the way, and go back to that screen I just showed you. There's a drop down under graph types, and this one's called insurance cost, which is the main reason I'm looking at this right now. I want to know what it's going to cost. How many dollars do I have to spend so I get X number of dollars of protection? I can click on that drop down and change that to insurance indemnity. If I want to look at what would this thing possibly pay. Then I've got these slides down below on harvest price, yield, and group yield, essentially. So I can move these up and down. And as I do that, these bars are going to move up and down as well. The bar in the back is showing what my dollar's worth of coverage would have been per acre. And this is showing me at 85% combined, I would have had about $825 an acre. At the 80% level with ECO, I'm getting about a little less than, or excuse me, a little over $800, et cetera. But it's showing me what the indemnities would look like. So in this example, if I said the price of corn went down to 380 in the fall, the yield in my farm yield was 200, the group yield was 200. This is showing me what these payments would look like. And it's showing me the combined payment between RP and the ECO. And what's interesting, if you look at all of these in the blue, the ECO maxed out at $87.10 an acre roughly, but my RP payment is a little different. So I can change these back and forth. I can type these numbers in to be able to show a situation that I want to show. Got a couple of questions here. Crystal said, what if the producer outperforms the county every year? I think those guys are the good candidates for this type of a policy. Because if you're, if the county typically loses more than you do, then in those cases, I think you're a great candidate for using the county type coverage. Brett asked, can you take ARP with ECO together? No, you cannot do that. That is one of the hiccups right now. Basically, you would be overlapping your coverage, and both would be on the county. So as of this year, you cannot do that. I know I've been asked that question a couple of times, and maybe that's something we take up with the RMA next off season. If you buy a lower level of ARPI coverage, for example, maybe you could be able to add this. And then another question, how does the organic work? That I'm not real sure about. Probably need to talk to the underwriter on that one. I would imagine that's probably going to be yield only. I don't know that for sure, but again, probably want to check with our underwriters on that question. One more before I move on. What happens if the fall price is higher than the projected price? Good question, Jordan. We'll address that here in just a minute. But if you have revenue insurance, you're going to get your dollars of coverage changed. It's going to be increased based on what the fall price is, just like your underlying revenue policy. So anyway, I think this is a really cool chart to be able to show you all these what ifs within the Easy Quote quoter. The other thing we can do within Easy Quote is to be able to look at history. And this is one of the big questions that comes up and was just brought up a second ago. What if my yields tend to be better than the county average? Well, how do you know that? We can do that within this historical tab on an Easy Quote. And so in this particular instance, this was for a person that we did not have their yields in the system yet. So it was a prospect, but I went in, I mentioned on that first screen and typed in my 10 years worth of yield history. And then it's going to plot those over the top of the county yield history. And so the final county yields for what they would have been for ECO and SCO. So the producer yields are in blue here. And in most cases, not all, but in many cases, the producer yields are at or better than the county. Yes, there were a couple of years in 14 and 16 that they might have been slightly below, maybe in 19. But I would say that this producer, to me, looks like an excellent candidate for the county insurance policy. If you look back in 2012, which was the bad year, the producer did better than the county average. So, I would tend to think that year in, year out, this producer over time is going to get paid more in losses on county coverage than probably on their individual coverages as well. But this is a pretty cool tool for those. I know you've got producers that are going to ask the question. Well, I don't tend to track with the county. I hear that a lot in the Western Corn Belt. I hear that a lot in South Dakota, Nebraska, Minnesota. My counties are too big out here. In Iowa, the counties are so big that I don't feel comfortable. Put your yields in and go track it versus the county average and see how they would have performed historically. And I would bet in many cases, your yields tend to trend with the county. They may not be exact all the time, but you'll be surprised at how close they end up. The other really cool thing in this historical tab is off on the right-hand side that we can look at what the historical payments would have been. And so I can set my span of years over here in the settings. And in this example, I said from 25 to 2019. Basically, that's about when the ethanol era started in corn. And so at the top of this, and down below, I can click on some other things. In this example, I just wanted to look at ECO. I didn't necessarily want to look at my RP payment as well. I wanted to look at what ECO would have done. I can set this up as a net by clicking this box, or I can unclick that box to just look at what the gross payments would have been. Up at the top part then across here, it's going to show me what these dollars worth of payments would have been. If I included my plan with my RP, it's going to show the combined RP and ECO payments. By doing this separately, just looking at ECO only, which is what I really wanted to do to be able to see how this plan would have performed. Then at the bottom, I've got this great chart to be able to look, okay, which years would ECO have paid in this county on corn from 95 to 86%. Kind of interesting that over the last 5 years, it would not have paid. And I think that there's some reasons for that. Number one, we started off in the spring with relatively low prices, and we had relatively good crops in those years. But look at the periods back when we had high prices. 2010 through 2014 were years that we started with pretty high base prices. 2008, we started with a relatively high price. And those are the years where I think drop in price probably is the thing that really triggered much of the loss. You can see, and exceptions would have been in 2011 and 2012. You can see up at the top what those prices were. But those are the years where we saw big increases in price and we saw the yields go down. And so, you know, it works in both ways, but it only takes a 5% drop in the price in order to start to do that. And so that's where I think that this policy is pretty cool. Dan in Nebraska asked the question, we are hail and wind risk counties, and I fear that if a customer gets hit hard with wind and hail, then he's in a bad situation to rely on the rest of the county getting damaged. I agree. I don't think that this is going to be a substitute for hail and wind insurance, especially in Nebraska. I think that's a separate peril that tends to be a farm related peril. What this may allow producers to do is, you know, you hate to use the term, but you may be able to double dip a bit. And it may allow you to lower your individual coverage. So maybe you raise your county level coverage, you buy your wind and hail, and maybe you lower your RP coverage in those instances. So just something to consider there. But this chart is going to show, you know, this is the history. And if you look at where you think prices are going to be this year, you know, what the potential downside is in price from where we're starting, you know, I would tend to think that this year represents more of what we had seen in the window back 8 to 10 years than it does over the last 5. Another question. Oh, Dan says, thank you. You're welcome. So moving on, ran a separate example. This is example number 2. Went back in here and said, okay, maybe 95% is too expensive. Maybe I want to look at the other coverage below. And so in this example, I ran an 80% RP coverage again with SCO from 80 to 86 and ECO from 86 to 90. The combined cost of those two is about $17 an acre. So quite a bit cheaper than what the 29 was we were looking at for the 95. Now, keep in mind, you're lowering your trigger. You're going from 95 to 90. So that's going to change the odds or the number of years where you're likely to trigger a loss. But what's it look like? Well, let's go in, look at the scenario. It's going to show me, again, what my costs would have been. And I just did the one this time just to show what the 90% would look like. But with the SCO, so it's going to show me my costs if I do 75, if I do 80, if I do 85%. Of course, the big cost savings here is from 85 down to 80. I take off $6. After that, I don't save as much if I'm replacing RP with SCO. So I'm probably looking at this 80% coverage. And again, I can look at, this is the insurance cost. I can go to the right and change to look at indemnities and be able to look up and down at those as well. But I moved on to the historical tab to show what it's going to look like, what it would have looked like in these instances. And you can see using roughly the same span of years, 2014 didn't get as much. Of course, you know, ECO paid at 95% that year. That's not going to pay very much at 90%. And you can see some of the other ones, like 2012 maxed out, I believe, that year. But some of these other ones aren't looking at as many dollars. And in fact, this maxed out at $55. At 95%, I believe it was $100 and some dollars. So again, your coverage is lower. You kind of get what you pay for. You're not getting as big a bang as you're going to get at that 95% level. But we can look at this and we can show the producer with, you know, with these charts. Here's what it would have paid in these given years. So if I think there's good odds that the price is going to drop this year, is it worth going to 95? Is it, you know, do I just stop at 90? You know, those are things that the producer can make a decision on based on how much money they want to spend on premium and what the potential dollars of coverage would look like. We've got a lot of tips and tricks available. You can go to the website, click on the tips and tricks page. Hope and the team put together a lot of neat stuff, the user guide to be able to go through and be able to show a lot of this stuff. We got some videos. So if you got any questions on quoting ECO, on how each of these different tools within the quoter works, go out here to the tips and tricks and you can see a lot of stuff there. The other big tool we've got is a standalone tool. This one is in the quoter that we just showed you. A lot of neat tools, a lot of neat stuff built there. Then we've got this standalone tool called the SCO, ECO Indemnity worksheet. To find this worksheet, go to the agent portal. Under the resources tab at the top, it's about halfway down, SCO, ECO Indemnity worksheet. This is an Excel tool, basically, to be able to show you cases, to be able to run a case of here's what it would have paid in a given situation. And so when I click on that tab, this is what's going to come up the worksheet behind. Looking down at the bottom of this set of this file, essentially, we've got a lot of information in here. We've got an expected yield list, which may or may not be updated since margin protection, but we updated this early with all of the margin protection county yields because they're the same. And so this might be a quick way, if you're going to use this worksheet, you can go onto this tab, look up your county, and like Christian County corn, grain, non-irrigated at the bottom, 213.5. We've got some other tabs on here, and these are for corn, soybeans, cotton, and spring wheat. And here's the corn tab. It's going to show you the 15-year history in corn price from February to October. A lot of us want to know, how many years has corn price gone down from where we started at? Well, this does the work for you. And so if you want to show our producer what are the odds that the corn price is going to fall from February to fall, you can do that here. And in fact, over the last 15 years, 9 out of the 15 years, we've had at least a 5%, actually at least a 7% drop in the corn price, which if we would have had an average yield, then ECO would have triggered in those years. So it kind of tells you that there's pretty good odds that the corn price is going to fall from February to October. Soybean price, maybe not. 5 out of 15 years, we've had a drop of at least, looks like 8%. But keep in mind, those years were ones where we started out at fairly high prices. We were double-digit starting prices in those years. And so here we are again, double-digit starting price. Maybe the odds are better that we'll drop in price this year from spring to fall. For cotton, was 1, 2, 3, 4, 5, 6, 7 out of 15 years, we've had at least a 5%, actually at least a 7% drop in price. So again, we're starting at 77, 78 cents this year. If that's relatively high, depending on what happens with acres and production, who knows what happens? Maybe it makes ECO look like a decent deal, or SCO. Spring wheat, I think 9 out of 15 years, we've had a drop of at least 5% as well. And so, the higher we start this base price in February, the better this ECO and SCO coverage starts to look. So just wanted to share this. This is in that tab. You can show this to your producers. Then the first tab is what I showed you before, is the worksheet. And so I can run through a scenario with the producer and say, what happens if? And we can also do that, as I mentioned in the quoter. This looks a little different. This shows you the math, how we calculate the loss. And really the only thing you have to do is change these yellow boxes. All of the other boxes are calculations that take place. And so in this example, I'm going to say that I bought just this 9% ECO window from 95 to 86%. That's in the middle of the screen up here. There's drop downs. I can click on the drop down, click in 95%, click the next one to show what the bottom end of my county level coverage is. So this might be an example where the producer, say, buys 80% RP insurance and then buys that 90% or that 9% window from 86 to 95 up above. So essentially leaving a gap. So I'm just looking at the ECO coverage only. And in this example, we start out with a base price at $4.55, but I'm going to say that in the fall, the price goes down to $4 a bushel. But I'm also going to say down below here that the county yield stays unchanged. So what's the impact of just the price drop from $4.55 to $4? So go back up to the top, we calculate our coverage. We use the higher of the base price and the fall price times my APH on my farm. Holy cow, $1,001 worth of expected crop value this year, starting at $4.55 and using this farmer's APH at 220 bushels. We know that the coverage level is 9%, or that's the band of coverage. I take 9% times my expected crop value. That gives me $90 of protection. That's where I'm starting at, with $90 of protection. So go back to the quote earlier. If I were going to spend $29 an acre to buy this, Essentially, I'm spending $29 to get $90 worth of coverage. It's about a 3-to-1 return. You can decide, your farmer can decide whether that's a good buy or not. Historically, I've always thought if you could get a 4-to-1 return, it's a really good deal. 3-to-1, I'm okay with that, especially when I'm up at these higher levels. If it gets below that, down closer to 2-to-1, then I'm probably not going to spend the money on the policy. But in this case, at 3-to-1, given if we're able to start at 455, maybe it's something I ought to look at. So the next section is calculate the loss. We started out with an expected county revenue calculated by 213.5 bushels times the base price of 455, $971. In the fall, our revenue is the 213.5 final county yield times the harvest price, which gives us the final county yield of or revenue of 854. Divide that by the revenue, we had about 88% of our expected revenue that we produced this year, which is below the 95% trigger. So we do the math. We had a 7.1% loss below their trigger. Divide that by our band of coverage at 9% means that we had about a 79% loss of that band. Multiply that by the $90 worth of protection, we get a payment of $71 an acre. So in this example, keep in mind, yes, we paid $29 for the premium, but if we think there's a chance that the corn price could go to $4 this fall, which I would say really good odds that that could happen in the fall of the year with an average crop, you know, you're going to get back 2.5 times what you paid in your premium. Let's look at a different example. Let's look at us using the same starting numbers, but let's say we had another bad year. Let's say that we had a yield drop to 150 in the county and the price went to $6 a bushel, similar to a 2012 type year. So when the price goes up, question we had earlier, what happens? When the price goes to $6, we get to use that price to calculate or recalculate our expected crop value. That goes up to $1,320 now. Multiply that by our 9% band. Now our protection went up to 118 compared to the 90-something dollars before. We recalculate our beginning revenue. Our expected revenue goes up to $1,281. Our harvest revenue is $900. Divide that. Essentially, the math quits at 86% here. And the reason it does is we had more than a 14% drop in the revenue. And in fact, if you did the math off the top of your head, we only raised less than 75% of our expected revenue. But it stops at 86% because that's where our coverage stops. Essentially, this is telling me I'm going to get paid 100% of this band of protection. And when I do the math out, it comes to 118.80. We get paid that entire dollar's worth of protection. So if I buy an 80% policy on my farm, then assuming if my yields on my farm track with the county, trend with the county, then I'm going to have at least a 5 or more % drop here that my RP policy is going to pay as well. So kind of keep that in mind, that the policies do work together. This shows me a matrix of all of the different possibilities. So if I go back and look at this first example a minute ago, we had $90.09 worth of protection. The second one was 118.8. Essentially, I'm looking at I looked at two examples there. This is showing me over 100. So $90.09 is my dollars worth of or my revenue dollars available in these lower price situations. But if the price goes up in the fall, as you can see over here on the left-hand side, my dollars of coverage goes up as well. So if we get up to $6, you know, now I'm up in that 118 area that we just looked at. But this is a really neat chart to look at because it also shows me it only takes a 5% drop in yield on the left to go to the left of this 100, or a 5% drop in price to where I start to trigger a payment. If I'm buying 90% coverage, that starts over here. I got to go over a couple more columns or down a couple more rows. At 85, if I'm buying 85 RP, I got to drop over another couple columns. If I'm buying 80, I got to go way over here. So it really shows me the value. You know, I'm looking in this 80% coverage window, I'm looking up here in the top of $90 to $120 payments before I would ever see an RP payment at 80%. So this year, especially with the prices starting where they're at, it's where I see the value of this policy. Let's look at another example. Let's go back and look at that second one I looked at earlier in the quoter. Let's say that I buy an 80% RP policy. So I buy SCO from 80 to 86 and then buy ECO from 86 to 90. Essentially, the math is the same. So I include these all together on this worksheet. So I'm looking at county level coverage from 80 to 90%. Below that, I've got my RP coverage. And we'll go look at the same two examples as a minute ago. First example, price of corn goes to $4, yield stays unchanged. In that situation, I would have had about again, the same math. I've got 87.9% of the county revenues expected, but that's only 2.1% below our 90% trigger. So I get paid roughly, at a 10% band, I get 21% of $100 coverage up here because I have a slightly bigger band than I had before with 9%, but I get $21 an acre. Go back before, I was getting 70 something dollars an acre. That's because my coverage was at a much higher level. Next example showed that when corn went to $6 with a lower fall yield in this situation, I'm going to get that whole 10% band. I'm going to get $132 an acre. Before, if you recall, I was leaving a gap basically in my coverage. I was going from 86 to 95. I got that whole 9% band, but I didn't get anything from 86 down to 80%. So if you're worried about a 2012 situation, maybe this is just as good as this is just as good as leaving a gap in my coverage and having that top end. But if I'm protecting against some sort of a shallow loss in revenue, like we might see if the price goes down, then having that 95% trigger probably is a better situation. Here's what the matrix looks like. And again, I'm lowering my starting point, sliding 2 columns to the left at 90%, and I'm lowering it 2 rows here on price as well. So just depends what the producer wants to try to cover. If you're trying to get that price trigger as high as you can, use it as a put option. The 95% is going to do that. I can see some pushback though because of the premium. And so that's why actually yesterday I went back and added this 90% situation to where maybe you buy the 90% with the SCO down to your RP level. You do it a lot cheaper, but you still get a 90% trigger this year. And with the prices having done what they've done lately, maybe that's okay to have that 90% trigger. I also want to give a commercial. Our IT group put together this flyer, which is an incredible flyer with a ton of information. Now, keep in mind, these have to be done manually. So if you want to get them done, it's going to take some time to get them done. I'm just throwing that out there. You're not going to get them tomorrow, but it's a great piece to be able to show producers. This is going to show the indemnity graph at the bottom. This is a net indemnity after the cost of the insurance. You can also get them done with gross, but it's also showing, at 95%, showing the percent coverage level, shows 6 out of 10 years ECO would have paid. A lot of good information on this piece of paper. So it's something that you could request and we could possibly get these done for you. Steve asked a good question, and I didn't bring it up. I just thought about it as I was reading this. What about doing ECO at 95%, but less than 100% of the price? That I did not run any examples with that. That is something you could consider doing in order to try to lower your cost, but keep your trigger as high as you can. And essentially that would work kind of like the RPI policies used to, or margin protection or whatever. You don't, in those situations, let me go back to the graph real quick, because that might show it better. In those situations, let's say I buy the 100% of the coverage or the trigger, but I lower my dollars of coverage to 80%. If I did something like that, then all of these numbers in this red would be 80% of what's showing right now. So in a loss situation, go back to the chart before, in this situation here, if I buy this, and I didn't put even a line in here for this, but if I lowered my dollars worth of protection, essentially I would take this 132 times 80%. I could save 20% on the premium, but I would also reduce my payments by 20% when I got paid. And so we can do that. I didn't look at that because I just assume that most people want to get the dollar for dollar. Sometimes it might be hard to explain to a producer after the fact that we had a loss in dollars, but you only got paid 80% of those, or 50%, or whatever the number is. But we can do that. And you can, and I haven't run a quote on it even yet. So that would be something I could look at, but it is available. You don't have to buy the 100% of the dollars. You could buy this down, which would essentially reduce your indemnity. So good question. So kind of, to me, it goes back to these charts I showed you earlier. I'm looking at this from a price perspective this year. Whoops, sorry. You know, what level of coverage do I want? How high do I want my trigger to be? Maybe in Steve's example that he was just asking me about, I want my trigger maybe to be as high as I can get it. And if it means I get paid a little bit less, maybe that's a way to save a little bit on the premium as well. That's a good situation. Same on soybeans. If I want my price trigger as high as I can get it to where I start to get paid something, maybe I'm, in some cases, maybe I feel like I'm better off not getting paid dollar for dollar versus dropping my coverage down to the 90% level. So there's some different things you can look at here. The good news is this year we've got opportunities with price where they're at to lock in profit. We haven't had that in a while. So there's a lot of different ways to be able to look at it. And I'm excited about the tools that we've got that you guys can use to be able to show your producers. Question was, can I buy a CAT policy? I think you have to buy an underlying revenue or a buy-up policy. I don't think you can do this with CAT. An underwriter may differ with that, but I think you do have to buy a buy-up policy. Even if it's 50%, 5,100 or 55, something like that. That's where I would go anyway, just because in most cases, you know, that gets you your prevent, plant, your replant. So with most crops, that's the way I would want to go. In the reality, I really see the majority of these policies being done in the darkest counties on here. If you get into the really, really light counties, and by the way, these are for margin protection. These show you where the yields were for margin. So I'm kind of borrowing it from margin to be able to show you for ECO. I would tend to think that from price perspective versus return, that the darker the blue, the more likely we are to write this year. Doesn't mean we can't write it everywhere. But for corn and soybeans, I would tend to think that the darker colors would be the better candidates. You get more dollars of return per dollar of premium. So just wanted to share that. That's my editorial comment, but it doesn't mean we can't, doesn't mean we won't write it in some of these other areas where producers are really trying to get the most dollars of coverage it possibly can. So that kind of concludes my part of the presentation today, or my presentation. If you've got other questions, feel free to shoot them to me now. You can email them to me. My email is rich.morrison@naoucountry.com. I will love to be able to discuss the product because it helps me learn along the way as well. So if you've got other things you want to talk about, share, make comments, ask questions, please give me a shout, and I would look forward to being able to discuss those. So thank you all for joining today. Sorry about the hiccups at the beginning. Look forward to visiting with you through the sales season if you got questions. Have a great day. We'll talk to you soon.